and gentlemen, and welcome to this webinar brought to you by FX Street. My name is James Chen. I am the Chief Technical Strategist at a company called CITYINDEX, and we're based out of London. Actually, we're part of the larger group now, Gain Capital. So, I'm based in the U.S., and this is my, sort of semi-monthly or monthly webinar on FX Street, and I'm all too happy to be back here. Now, today what I'm going to be doing is I'm going to be doing something a little bit different from what I usually do in terms of talking about technical analysis and in the currency markets. I'm going to be talking a little bit more today about, strategies for managing your trades, which includes scaling in and scaling out of trades, and both of which I use very extensively in my own trading. So I'm going to be talking about scaling in and out of trades. Also, I'm going to be taking a look at the different currency markets that we have. Of course, we had a big week last week in terms of the FOMC meeting and the decision to hold rates unchanged in the U.S. And I'm going to talk a little bit about that and how that affected the currency markets as well as commodities and indices, et cetera. I'm going to show you my charts and talk a little bit about that. But first, let's get started talking about managing your trades, scaling in and out of trades, and we're going to get to all of that in a second. If you have any questions during the course of this, feel free to type into the chat window, and I'll be more than happy to get to any questions that I see. Okay? All right, so let's get started real quick. Okay, before we get started, just a quick disclaimer. Financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, let's move forward. Now, in case you're not familiar with me or what I do, who I am or what I do, just a quick overview. Some of you may be familiar with me. I have been on FX Street doing lots of webinars for many, many, many years. I'm the Chief Technical Strategist, as I mentioned, for CITYINDEX Group, which basically means what I do is on a daily basis is I trade, not just the currency markets, but I trade, the equity markets, the commodity markets, as well as individual shares and stocks. I analyze the markets. You'll be able to see this on our website. I have it right here, actually. This is our website at cityindex.co.uk, and here I am, and I provide analysis along with my colleagues on a daily basis with regard to currencies, commodities, indices, individual shares, etc. Okay. I also educate, much like what I'm doing now. So I run webinars on a weekly basis. For CITYINDEX, and then of course, as I mentioned here on FX Street. So that's pretty much about me. I've been doing this for a long time in terms of started out in currencies and equities, but have really been into pretty much all the markets in terms of analysis and trading, and also educating people on how to trade. Okay, so let's get started real quick. Now let's talk about scaling into and out of positions. I'm going to start talking about scaling into positions first, and basically what this means is, you can, for most people, what they do is they would get into a trade and they would put all their eggs into one basket, so to speak. So if you get into a trade, let's say on euro dollar, for example, you would just put in a trade, a full position into euro dollar, and go with it, and then you have your stop loss. Some of you would have stop loss, others won't, and then you'll have your profit target, etc. So that's the traditionally the way people begin trading. Now, in terms of scaling into position, the point of this is really not to put all of your eggs into one basket, so to speak. You want to be able to diversify your positioning. Now, not only, when we talk about diversification, most people, when they talk about diversification, they talk about not putting, everything into one position, into one market. Okay, you want to diversify among different markets, preferably markets that are not correlated with each other. But not only that, you want to be able to diversify also your positioning because, if you put a full position onto one particular market and then at one particular price, then you're really committing yourself to that position. Whereas if you're scaling into position, you could sort of, what we say, dip your toe into the water to see if this position is in fact a good one, or if it's moving in your favor, or what have you. And then you could scale into position like that. Now, there are four different ways that I talk about scaling into position. And it depends really if you're long or short a particular market. But if whatever direction you're going in, there are basically two ways to scale into position. One is you're scaling. Let's say you're going long. Let's say, for example, you're going long euro dollar, just to make this as simple as possible. If you're going long euro dollar, scaling up would mean adding to your winning trades. So, for example, instead of placing one trade at one price on this one market, perhaps it's better to get into the market with a fractional trade, something smaller than a full trade, and then progressively get into the market with further fractional trades. So, for example, again, if you're going long the euro dollar, you would put in a trade at a certain price, and then if it goes in your favor, if this market goes in your favor, you would add to the position as it goes in your favor. Now, this is a favorite technique of trend followers. Why? Because trend followers like to stay with positions, for the relative long run. Okay, so they want to be in a position, but they want to be able to have confidence in this position to stick with it. And this is one way to do that, by scaling up on a long trade. So, for example, I actually have diagrams, so I'm going to show you in a second. But just let me first go over these different types of scaling into trades, and then I'm going to show you the diagrams and then my charts after that. Okay, so another way to scale in is by scaling down. Okay, and this is not a favorite technique of trend followers. This is rather a technique used by people who like to get into trades and then like to average their positions. Okay, so let's say you get into a trade. Again, let's say you go in long euro dollar, and then with an incremental trade, with a fractional trade, and then let's say price goes against you. And then at that point, some of these people that like to scale down will add a fractional trade at a lower price. Now, what does this effectively do? What this does is that it lowers your average cost. Now, I didn't say this is a good way to do this, but many, many people do this. And, it tends to work better for markets like individual stocks and individual shares because, there's a certain limit to, there's not a limit, but in terms of, value, if you're investing for value, a lot of people, if they have a good stock on hand that they're looking to get into, and then the stock tends to dip, then they might add to the position to lower their average cost of getting into that position. It doesn't work so well with currencies because we have long trends often on the currencies. On the currency pairs, so oftentimes you'll see big downtrends, and if you're scaling down with those big downtrends, it can get very, very risky, and you could have catastrophic losses on hand if you tend to do this. So that's why I put a little asterisk here, because in terms of this, it can be very risky, but it's still done nonetheless. So I'm going to explain all this in a minute. Now, the opposite of going long, of course, is going short. Now, when you go short, a good way to add into a position for a trend follower is to scale down by adding into position as the market moves in your direction to the downside. So basically, you're adding to winning trades. And then I'm going to show you this diagram in a second. And then the opposite of that is if you're going short, is scaling up as the price or the market goes against you. You're adding incrementally to losing trades to reduce your cost basis. Okay, and again, a little star here just to say that there is risk involved here, but this is done on a very frequent basis. Okay. So I'm going to show these diagrams right now and just show you exactly what I mean by scaling into position. And then I'm going to talk about scaling out of position, and then we're going to go to the charts. Okay, so first of all, let's say, again, you're going long. Okay, so this is basically what this means by scaling up or adding to winning trades. Okay, so we have the trade direction, and that is to the upside. So you've decided to go long into market. Now, instead of placing these are price levels here, okay? So these red lines here are price levels, and these plus signs are simply adding to your position. Okay, so let's say you get into a position right over here. If you could see my mouse pointer, you get into a position there with a full position. Now, and then let's say that it keeps going up and up and up. Now, why would you not get into a full position on the very bottom here, as opposed to adding the positions further on? Why would you not want to do this? Adding a full position at the bottom, you would have made a lot more money than if you added to your position as the market went up with you. Now that's fine, but the answer to that is, why would you not do that? Well, because you don't know that the market's going to do this. Okay, so despite being a trend follower, we don't know if a trend is going to continue, if a trend is going to keep going up, or what have you. So basically here, of course, it would be much better if you got into a full position on the very bottom here and you rode it all the way to the top. You would have made the most money there. But we don't know the right-hand side of the chart, okay? So we don't know what's going to happen with this market. Therefore, a technique for getting into position preferably, adding to the position as the trade develops, then this is a good way to do that. So here we have, let's say this is one technique here. So as we have a trend going up, we see a break to the upside above the last peak. Okay, so we get into with a small position. Maybe we get into a fifth position, or a 1/5 of the size of our regular full position, and then we get in as it moves in our direction. Then we add to our position like so. So we add here, and as it breaks out to new highs, we could add positions as the market further develops and goes in our favor. Yes, you won't get as much profit as you would if you had put the full position on the very bottom, but this is a good technique for dipping your toe into the water, seeing if the market is moving in the direction that you think it's going to move in, and then committing yourself slowly as opposed to quickly. Okay. Now, why would you commit yourself slowly as opposed to quickly? Well, if you get into position here and on the very bottom, and the trade does not develop in your favor, then you have a smaller commitment, and your loss, if you take a loss, will be much smaller than if you had put in a full position at the very bottom. Okay, so that's basically what that means. You're committing yourself slowly as the market, as the trend develops in your favor. So that's one way to scale into position. Okay, so now let me show you another way to scale into position if you are also going long. Okay, so this blue line here, this blue squiggly line here is the market. Now, let's say you want to look for a bottom in this market. Okay, so you're looking to get in at a low price, which many people like to do, and this makes sense. So let's say on a dip in the market, you get in with a long trade. Okay, again, the trade direction is to the upside. So as it goes lower, okay, let's say you get into this trade, you want to go long at a certain point. You think this market is undervalued. I want to get into this market, and I'm looking for a turn back to the upside. This is an oversold market, let's say. Okay, and of course, markets will go can continue to go against you, as they often do. So then what this trader might do is, okay, so I'm in a losing position, but I only have 1/5 of my usual size of trade. So I get into that position, and then as it goes against me, okay, so now let me buy some more. Okay, so let me buy some more, and as it goes against me, and then I'm going to average my position. So at that point, once I got into the first position and then I got into the second position, my actual cost of this position is right in the middle. Okay, so I've managed to lower my cost basis or reduce my cost basis incrementally on this long trade. Okay, and then let's say it further goes against you, and then you add another trade to go long, and then again you've managed to lower your cost basis even further and further, and some people do this indefinitely until they blow out their whole account. Well, in terms of this, that's why I put a star there. This can be a very risky way to trade, especially if you're trading the currencies. It makes sense sometimes when you're trading with, for example, individual equities, as I mentioned, or oftentimes commodities as well. Although we've seen, lots of big downside for many commodities, including oil, crude oil, including gold, et cetera. So, this can be a very risky way to do it. But if you've got the right technique, the right strategy, and the right markets to use this with, oftentimes averaging down can be used effectively. Okay. That being said, it's not something that I would use all the time. And only in very specific cases, because trends can go against you, by a lot, as we've seen in many of the markets. But scaling down can be used as one technique in certain instances. Okay, so let's go to if you're going short. Okay, so it's the same type of thing going short. Scaling down makes a lot of sense, especially if you're trying to catch a trend. So again, the trade directions to the downside, you're following the trend down. Okay, like we've seen for oil, for gold, et cetera. We've seen a big downtrend for Aussie dollar, et cetera. So if we see this downtrend develop, again, we could add to our short positions as the market continues to go down. And again, these are smaller fractional positions as opposed to committing yourself to one short trade at one price point. Okay, so you're getting into fractional trades here. As the trade develops to the downside, you're getting in and further committing yourself to this market as it continues down. Okay, and I'm going to talk about how to taking profits by scaling out in a second. Okay, so that is scaling down. Now, again, this is the opposite of that. This is scaling up when you're trading short, and as the market goes up, you're selling short on fractional positions to average your cost up. Okay, and you hear a lot of people say, never add to your losing positions, and never do the dollar cost averaging thing, because it really doesn't make sense, and you get yourself into a lot of trouble. And for the most part, these people that say that, and myself included, are telling the truth. It can be very risky. However, again, in some instances, it can be used, especially instances, for example, when you're trading stocks or what have you. But for currencies, it can again be very risky. So again, I am giving that disclaimer once again. This is one way to scale into trading, but it is probably one of the riskiest ways to do it. Okay, so again, this is adding to your position as the market's going against you. You're going short, the market's going up, and you're adding to the position. Now, the only good thing about this is that you are averaging your cost up. Okay, which is a good thing if you're going short. Okay, so your cost basis will be higher and higher, and if you're going short, that's a good thing. So if and when the market actually comes to the downside, then you can be in position to take your profits from there. Okay, so those are the four ways of scaling into position. Again, scaling by adding to winning trades is something that I do very often. Scaling by adding positions as the market goes against you is something I do not do very often, but it can be used in specific instances. Okay, now let's talk about scaling out of position. Now, what's the point of scaling out of position? The biggest advantage of scaling out of position is locking in your profits. Okay, so what does this mean? Let's say the trade direction is to the upside. That means you're going to go long a certain market. And, as the market develops in your favor, you're taking positions off incrementally. Now, again, why would you not just take your position off at the very top? When you would make the most, take the entire position off at the very top when you would make the most profit. Well, again, we don't know what's beyond the right edge of the chart. We don't know that this is going to continue going up as we can see here. So right now we have the benefit of hindsight in our favor. So we see that the market continues to go up, but we don't know what's going to happen. So that's why what we're doing is we're scaling out of positions by taking profits off at progressively higher prices if you're going long, so that you can lock in your profits. Okay, and this can also be used in conjunction with moving your stop loss. Okay, so what does this mean here? So let's say this black line right here is your original. Your full position. Let's say you have a full position and you're on this black line right here. Okay, so that's where you went long. Okay, so now what you could do is you could take off a part of that position as it moves in your favor. Okay, on each of these red lines. This minus sign simply means that you're taking off positions. So you're essentially locking in your profit by taking off part of the position at each of these levels. And this is a very, very commonly used, technique for locking in your trades. Now, this can, again, as I mentioned, this can also be used in conjunction with moving your stop loss in the direction of the market. So, for example, once again, let's say that you had an original position to go long this market at this black line right here, okay? And then let's say your original stop loss was a little bit below there, okay? If you could see my mouse, let's say, if you could see my mouse pointer here, let's say your original stop loss was below the low of this dip right here, okay? Now you're going long, okay? So now at this point, when it hits a certain level, and this level can be determined by many things, including support and resistance levels, or you could have set number of pips that you use that you could take your first profit, etc. Okay, so let's say the market goes up there, and then you take off a quarter of the position. Okay, and you had your original stop loss down here. Below the dip there. What you could do in conjunction with taking off the first part of your position in order to further decrease your risk is to move the stop loss of the remaining position. Okay, so let's say this is a 4-part position. Okay, and you took off one quarter of it at this level right here in the first red line. Then what you could also do is you move your original stop loss up to break even for the remaining 3 positions, okay? For the remaining 3 positions. So at that point, if the market takes you out, then you're out of the rest of the position, but you're out at break even, okay? So you could do that. Now, as it moves further, then let's say at another certain position that you've predetermined, you take off another position, okay, and you take your profit on that position, and then you can move your stop loss from break even up to this first level right here where you first took off a position. Okay, so now you have you've taken your profits on 2 positions, and you have your stop loss for the remaining 2 positions right here at a profit, which means that if the market subsequently turns around and takes you out, then you have a profit not only on the positions you took profit on, but also on the positions that you let run. Okay. So now, what is the point of all this? The point of all this is to have trades that have the highest probability of at least providing you with some type of a profit. Yeah, you're probably not going to hit a home run as you would if you had gotten into original position here and then at some point in the future taken off the entire position somewhere up here. But then again, as I mentioned, this is we have no idea if this trend is going to continue going. Markets are fluid, markets are volatile, and you want to be able to lock in as much profit as you can on the trades that you take. So this is another way to have a higher probability of profiting on your trades. Okay. Okay, so this is also a way to manage your trade. Now, another point I want to make here is that not only can you do it this way, but you could also not only can you scale out from a full position, but you could also use this in conjunction with scaling into trades. So what I just mentioned before, let's say you're going long, okay, you're scaling into a trade by adding to your trade as the trend develops, but you could also scale out of positions by taking out those fractional positions at different price levels. Okay, so you could use this in conjunction with each other in order to have a better or a higher probability way of profiting on your trades. Okay. So again, I think this is pretty straightforward. You're taking off trades until you finally take off your last trade at a certain predetermined point, at which point you've made profit on each of your trades. Okay, on each of your trades. Of course, you didn't make the full profit as you would have if you had taken it off at one level at the very top here. But again, we don't know any of this. So you're locking your profits, you're making profits along the way, and you're cutting your risk the whole way, and you're managing your trade. So basically, this is a way to you hear people talk about cutting your losses or and letting your profits run. This is a way to lock in your profits and let your profits run at the same time. So you're locking in profits at a certain level, and also, part of your position, you're allowing it to run as the market runs in your direction. Okay, so hopefully this makes some sense. And a lot of people already do this, so this should be pretty straightforward. Okay, so in terms of going short, okay, same thing, just in the opposite direction. Here we have the trade direction to the downside. We want to go short, and then as the market moves, let's say you get into an original position at this black line right here, you get in short, and then you could take your positions off in increments as the price goes lower in your favor. You're taking off fractional trades. You're locking in your profits as you let part of your trade run with the market. Okay, and of course, if the market does not run in your direction and comes back and takes you out, you've essentially lessened your risk. You've decreased your risk. You've locked in some profit, and if you're also moving your stop loss, then you've managed to decrease your risk, tremendously that way. Okay, so if you are risk averse and you want to trade, oftentimes you see people get into full positions, and then it goes in their favor. They fail to take profits on that because they want to run their profits, and then the market comes back and takes them out for a loss. That's probably the worst trade that anyone could have, because if you see profits, oftentimes you want to take it, but at the same time, you want your profits to run. This is the best, one of the best ways to do this. Okay, so that's scaling out of positions. Okay, so now let's go to the charts, and let's just talk about the markets a little bit. If you have any questions, please feel free to type them in. Now let's just talk a little bit about what's going on with the currency markets. Now, of course, as we had last week, we had a hugely anticipated announcement from the FOMC, which is the Fed, the Federal Open Market Committee here in the U.S. And all of the speculation was whether or not they were going to raise rates for the first time in over 9 years. And that would have moved the markets a great deal. Now, of course, there's been lots of speculation with regard to that. And what happened, of course, is that the Fed decided to keep rates unchanged, and that is primarily because of global economic problems. Okay, so in terms of that, what happened there? Basically, because of global economic problems, because of inflation not being where the Fed wanted it to be in terms of the rate of inflation, they're holding off. But the broad market consensus is basically that there will be a rate hike, an initial rate hike, sometime by the end of this year or shortly after, if not by the end of this year. I think most people, or most the market is pricing in something some type of rate hike in by December. Okay, by December of this year. Now, what does this mean? Well, interest rates are the biggest movers of the currency markets, and therefore, the dollar could be the biggest beneficiary of a rate hike, and that's why, we've seen the dollar, increase drastically over the last several months, and actually since last year, over the anticipation of this rate hike. Okay. Now, what are we seeing? What happened? Okay, so let's take a look at the euro dollar. Now, the question here: do I see parity in euro dollar? Yes, I do. I do see parity in euro dollar. Okay, and I'll tell you why I see that. But anytime soon, it depends on what your definition of soon is. But what I see here is that I've been a euro dollar bear for quite some time. You look at any of my analysis, I'm always looking for the 108 level again, okay, and the 105 level. Why is this? Again, because just because the Fed did not raise rates last week, the expectation is that we're in a tightening cycle. The U.S. is in a tightening cycle, and we are going to raise rates at some point or another, and that's gonna push up the U.S. dollar. At the same time, the ECB has been rather dovish, so in terms of raising rates, not going to happen anytime soon. So what we're seeing here is, although we've been in a pretty much of a big trading range here, I'm looking for further downside on euro dollar, and we saw that when the Fed failed to raise rates last week, we saw a big move down in the U.S. dollar, which translated into the euro dollar moving back up to the 114 level, which was key resistance. Okay, approximately key resistance. Of course, we saw that big move to the upside back in late. Let me see here. Late August, okay, that went all the way back up to the 117 level or so, but I am looking for further downside because of the the rate differential, or the path of interest rates in both in the U.S. and in the for the ECB. So here we see that we had this short-term uptrend line here. I'm looking for further downside. My target's at 111. And, I've been talking about this 114 level for quite some time as being very strong resistance, despite this pop to the upside that occurred in late August. 114 is very strong resistance. This whole area right here is very strong resistance. And, again, as I mentioned, after the right after the Fed left rates unchanged, we saw a big move down in the dollar. But then on Friday, the dollar resumed again. It sort of shrugged off that what happened with the Fed, and now it's looking to the downside, and it's continuing to look bearish. And this is good for me because I've been bearish on Eurodollar for quite some time. So looking to the downside towards the 111 level. And then here, just as a point of note here, we have the 50-day and the 200-day moving averages sort of converging here. But I'm looking for a break below all of these towards the 108 level, and then 105 level, and then, yes, eventually down to parity for Eurodollar. So I am looking for parity as a long-term target, but for now we have some specific targets in mind, including 111, 108, and 105. Okay, so this is pretty clear on Eurodollar. Okay. All right, let's take a look at dollar yen. Dollar yen now. Dollar yen I've talked about a lot in the past. Now, what is it with dollar yen, and how does it move? Well, of course, it moves according to how the U.S. dollar moves. But the thing about the Japanese yen is that it's very it's known as a safe haven type of currency. Okay, it's a safe haven, which means that people. People or investors like to flock to the yen in times of market volatility, and we saw this case in point in late August right here. So we saw this big move to the downside, okay, and this was corresponded with the big move in the downside for equities. which include the S&P 500, the FTSE, the German DAX, all of that. So we saw lots of volatility, and this was caused by what was happening in China with the economic growth problems, as well as their financial markets, the Shanghai index. We saw that big move to the downside, and then we saw a flight to the yen, and this was seen in this big move to the downside for dollar yen. Okay, so this was a flight to the Japanese yen. Not so much the weakening of the U.S. dollar; it was more the buying of the yen that drove this. This move to the downside, and then we saw a low right around the 116 level. Okay, so that was a very big low there. And then we saw this, moving sort of like in a triangle type fashion. And then what happened with the last week, we saw an initial move down for the U.S. dollar, as I just mentioned, and also a move down for stocks. You saw that big drop in stocks. I think we sort of recovered a bit today, but last week, on Friday especially, we saw that big move down in stocks. And this sort of translated into a move below 120 for dollar yen. But then again here, because we had a slight recovery for stocks, as well as a rebound in dollar, we see this move to the upside in dollar yen. But overall, I'm seeing more market volatility coming, or I'm anticipating more equity market volatility, and therefore I'm looking for further, buying the yen and a possible further move to the downside for dollar yen. Okay, so you could say that I'm both a bear on euro dollar as well as dollar yen because of this link of the yen to as a safe haven type of currency. We're looking for a strengthening of the yen, and a possible further move to the downside. Now, the downside for dollar yen, though, although I see downside for dollar yen because of the equity market volatility, the downside for the dollar yen is likely to be limited because of the strength of the U.S. dollar. Okay, because of the possible or the probable continued strength of the U.S. dollar, because let's face it, even though we haven't had the initial, the U.S. has not had the initial rate hike yet, the first in over 9 years, we are, for all intents and purposes, in a tightening cycle, and we do have targets for higher interest rates, and therefore that can only help support the dollar. So in terms of downside for dollar yen, I do see further downside. I'm looking actually down towards the 115.50 level. Okay, but in terms of further downside there, it's not like I'm looking for a major trend move where we're looking for a long-term downtrend for dollar yen at this point. No, I'm not looking for that. I am looking for downside in the short term because of equity market volatility, but in terms of the dollar, it should be supported because of because of interest rates. I don't like to say definitely, but most probably moving up in the near future. Okay, and it should be either by the end of this year or the beginning of next year. And then we have to speculate with regard to the pace of tightening. Okay, how quickly the interest rates are going to rise. Okay, so I am looking for downside on dollar yen, but the downside should be limited. Okay, pound dollar. I'm also downside on pound dollar. Why? It also has to do with interest rates. Now, the UK is also expected to raise interest rates. Okay, and so originally, or in the past several months, the speculation has been that the U.S. will be raising interest rates earlier than the Bank of England. Okay, so therefore, we saw some weakness in the pound dollar because the selling of the pound and buying of the U.S. dollar, and I see that continuing to be the case. That even though we didn't have a rate hike, we're still looking for the U.S. to hike before the U.K., and therefore we should see further downside. I've got my target down at 152 on pound dollar, and then I've got upside resistance at 158. and of course up around the 159 level up here. But essentially, I am looking towards the downside towards 152 support. This is pretty strong support here at 152, and then further to the downside, I'm looking towards 150. Okay, but the downside should be limited somewhat because the UK will most probably also be raising rates. So, we could see a lot of back and forth here, a lot of choppiness, but I am looking towards the 150 level. Whereas on euro dollar, I am looking for a lot of further downside, and as I mentioned, down towards the parity level or so, or even lower. Okay, but on pound dollar, there's going to be lots of choppiness because of the rate, the rates speculation on interest rates both in the UK and the US. But I'm looking for downside towards the 150 psychological level. This is also a very strong support resistance level. Okay, Aussie dollar. Let's take a look at Aussie dollar. Now, this all has to do with dollar, I know, but these are the major pairs that I'm looking at. So Aussie dollar, I've been a bear on Aussie dollar for a long time. I'm looking for progressively lower lows, mostly because of the U.S. dollar, but also because of the Australian dollar and the weakness in commodities, which include gold. And you've seen the weakness play out in gold, and that's partly responsible for this downtrend on Aussie. Now we've had this very sharp, very long-term downtrend on Aussie dollar. My targets were progressively lower at 75, then 70, 72, then 70, and my 70 target was hit. And that was also basically, the Reserve Bank of Australia talked about their target being around the 70 level as well. This was back, months before. But looking towards the 70 level now, what happened here is we hit resistance right back up here at the 72 level on this rise. Okay, and this is also where the 50-day moving average is. I'm looking for further downside, back down towards the 70 level, and then my ultimate target down at 68. Okay, 68 is not my ultimate target, but my medium-term target is down at the 68 level to continue this long-term downtrend in Aussie dollar. Okay, dollar Canada. This is a very interesting case here. Let me just take a look at oil real quick. Let me just see what it's doing. Okay, oil recovered a bit after that big down move. Okay, so let's take a look at dollar Canada. Now, dollar Canada is very closely correlated, or the Canadian dollar is closely correlated with oil in many cases, or is often highly positively correlated with oil. So when you see moves up in oil, oftentimes you'll see moves up in the Canadian dollar. Right now, it's not really playing out, but right now we're seeing on the dollar Canada more. It's more driven by the U.S. dollar. But anyway, this big move to the upside, this big uptrend here that's been going on for quite some time. We see this multi-year high up here at 133.53 around. Okay, so what's been responsible for this move? It's basically been, as I mentioned, the U.S. dollar, of course, has been very strong, and oil has been very weak. Now, where do I see dollar Canada go? I had this little triangle pattern here, and I was looking for a break to the upside. Of course, because of what happened with the Fed last week, we saw a move to the downside for the dollar. I mean, an initial knee-jerk reaction to the downside for the U.S. dollar because of the rates being unchanged. But overall, what do I see? I see upside. I see further upside for dollar Canada. Why? Again, the U.S. dollar. I believe we are in a tightening cycle, monetary tightening cycle. The U.S. dollar should be supported by that. Of course, there's going to be fluctuations, but the U.S. dollar should be supported by this cycle that should be starting, by the end of this year or shortly thereafter. Also, as I mentioned, Canadian dollar is driven to a large part also by oil, by crude oil. Where do I see crude oil going? I don't see it rising very far. Okay, if it rises, if it bounces from being oversold, that's fine. But I don't see it rising very far in the foreseeable future. Why? Because we have these oversupply issues that are just that just keep going, and it's very difficult to alleviate these oversupply issues, especially also with Iranian oil coming on the market. Also, the in terms of OPEC not yet willing to rein in production. Also, the U.S. is in terms of the fracking and the oil production is also very high. So in terms of the oversupply situation, it's I see it only getting worse in the near term. Okay, and also in terms of demand, we've got China, their growth problems that could also affect the demand. So we've got a combination of oversupply and then economic troubles, contributing to under demand, and what you've got there is a perfect recipe for lower oil prices, or prices that are at least going to stay low as where they are right now. Okay, so that's basically what I'm seeing in oil, and therefore that should keep the Canadian dollar, somewhat pressured. And you combine that with strength in or the U.S. dollar that is being supported, then you see a possible further move for dollar Canada to the upside. I'm looking for 134 has been my target for quite some time, and then from there 136 is a resistance level to the upside. So I'm looking for a further continuation of this long-term uptrend, especially this uptrend that began in the medium-term uptrend that began in mid-June. Okay, so this has been very sharp, and this has really corresponded with strengthening dollar and weakening oil prices. Okay, let's see. Yes, next year Iranian oil will be back. Pound dollar at 145. I agree. To a certain extent that pound dollar will go down. Yeah, so that's basically that. I think I'm running out of time here, but if you have any other questions, please type them in. Quickly, let's go over. Let me see. Yeah, yen crosses. Let me see if I have any yen crosses here. Yeah, I mean it's the same type of thing. Let me see. Okay, this wasn't really set up, but yeah, I'm actually looking for downside on the yen crosses as well. But again, this would really depend on at least for the yen, it would depend on the volatility, the market volatility, like I mentioned for the dollar yen, it's the same type of thing. It will be, or it should be supported because of the U.S. dollar, but I'm looking for further. If there's equity market volatility, then the yen should be strengthened, and therefore dollar yen should go down. But of course, again, the U.S. dollar should support that somewhat. Okay, let's take a look here. Okay, I think I've run out of time here, actually. I'm sorry about that. I think I talked a little bit too much, as I always tend to do. Hopefully you got something out of what I talked about today in terms of these scaling in and scaling out, and also my market view. If you have any questions, as always, please feel free to contact me at james.chen@cityindex.com. That includes any questions that I didn't get to today. And anything you want to talk about in terms of the market, I'm always available at james.chen@cityindex.com. And I would like to thank all of you for your time today, and see you next time. Thanks so much.